We've already seen the ECB reversing course last week. They're going to begin QE again, and the Fed's headed that direction too. And I think eventually that it'll just become too great for that resistance line to hold. Price will get through there, it'll probably pull back, and then it'll rally on, and we'll end up having what I think will be the best year for precious metals since 2010.
Hey there, Silverbug. What do you get when you combine SD bullion and the New Zealand Mint? You get the lowest price silver coin ever released to the world. Introducing the Roaring Lion, a 1 ounce, 4 nines fine silver coin with micro engraving security that retails for lower than some of our competitors sell silver bullion rounds for. Check out this magnificent beast, the Roaring Lion silver coin, at sdbullion.com/roaring. That's sdbullion.com/roaring. All right.
Hey everyone, this is Elijah Johnson with silverdoctors.com, and back with us today is Craig Hemke from TFMetals Report. Craig, thank you so much for joining us today.
Elijah, it's always a pleasure, my friend, and looking forward to talking to you.
Definitely. Now, just in the last couple of weeks, I mean, if we look back, we saw quite a bit of a run-up ever since the beginning of the year, and actually before then, in precious metals. And it seemed, it was ready for a pullback, I guess. We saw a pullback in the last couple of weeks. Where do we stand right now?
Well, I'm trying to remember the last time we visited. I guess it was probably about 6-7 weeks ago. And we talked at that time that the rally in gold, though maybe helped along a little bit in December by safe haven demand, if you will, because the stock market was crashing. But that's not what was driving it. What was driving it was a recognition that the global economy was slowing, the U.S. economy was slowing, that the Fed and all the other central banks were going to eventually move from this idea that they were going to tighten and normalize, whatever that meant, to back to a regime of loosening and even more quantitative easing. Gold anticipated that, silver too, and they both moved up rather dramatically into the end of January, and then they pulled back, and then they both surged again into the 20th of February. At that point, from just a technical standpoint, they'd both gotten overbought. The commitment of traders reports that we like to follow showed that there'd been this mad rush of speculators on the long side, which meant the banks and the commercials were on the short side. And if you follow these markets long enough, you know what's coming next. And down we went. That seemed like that was pretty well done 9 or 10 days ago. And not surprisingly, we rallied back some. And then today, as you and I speak, we're giving back some of that today. What we're seeing now, Elijah, is just kind of a consolidation after that pullback, with the Fed meeting again on Wednesday, the 20th. We'll get the statements from the Fed. I would imagine that's just going to prompt another rally. April is usually seasonally a good month for gold futures. And I think we're just kind of poised to take another stab up there at, take another stab up there at 1350, 1360, that level. Now, that's a very important level, because I'd invite anybody to go to any charting service that they can find for free on the internet. And you can pull up a weekly chart of the last 5 years. Gold has not closed above 1360 on a weekly basis, except for 1 week in April of 2014. Okay. Now it's tried a couple times. It's had some intraday and intra-week highs up above 1360, but it has never closed above there. And so it doesn't take, some kind of certified technician to realize that 1360 is a pretty important level. Everybody's going to be watching it. It might take one or two more efforts before we get through there. But as we go through the year, and you and I maybe will talk about this as a refresher for everybody. I mean, we've already seen the ECB reversing course last week. They're going to begin QE again, and the Fed's headed that direction too. And I think eventually that it'll just become too great for that resistance line to hold. Price will get through there, it'll probably pull back, and then it'll rally on, and we'll end up having what I think will be the best year for precious metals since 2010.
Well, that's very interesting. Yeah, so essentially you're saying that the 1360 level for gold is a really key resistance point, and we're going to need some sort of catalyst. We're going to need something from the Fed saying that, we're doing quantitative easing more, or a significant amount of easing to break through that level. Is that what you're saying?
Yeah. The key thing for people to remember is that the price of gold and the price of silver is not determined by physical trading. It's determined by the trading of these derivative contracts. You got the banks that supply the contracts and the speculators that buy it. And as long as they're kind of on equal standing, then the price can get held at a level like that. What I'm suspecting will happen as we get maybe summertime, Elijah, before we make it this far. And that's kind of how it worked in 2010, too, I should point out. Prices were pretty flat through the first half of 2010 as well. It was only in the fall as the economy slowed and then QE2 got announced that prices for both gold and silver took off into 2011. So we may kind of be pinned up against that level and going sideways, kind of like what we were like in the first 4 months of last year, through the first 4 months, 5 months of this year. But I think with the Fed capitulating, and there are all these different metaphors that come to mind, the tide going out, the realization the emperor has no clothes. They've been telling us for the last 5 years that things are going to go to normal. They're going to shrink their balance sheet and interest rates are going to go back to 5 or 6% and whatever normal is. And it's clear that none of that is the case. None of that is true. If rates went that high, interest on the national debt would explode. All these different reasons. And so therefore, as this rationalization and realization sinks in, that demand for gold in all its forms, even these futures contracts, will just continue relentlessly, eventually breaking through the ability of the banks or whomever to control it at that resistance level. And then everybody sees the breakout and goes, wow, look at this. After 5 or 6 years, gold's finally breaking out. I got to get some, because that's kind of how the momentum trade works. And then it kind of builds on itself. So that's probably about how it'll play out.
Now, with respect to the economy, I know we had you on last time. It was late January, and you were saying that it looks like come the fall, we're going to see a crisis, and the Fed will keep stepping in and maybe do some more easing, and then that'll really push precious metals higher. Can you give us an update on the economic situation right now and how you're seeing it develop into the fall?
It certainly seems to be playing out right on schedule. We had the fourth quarter GDP numbers come out, and they were a little higher than expected at whatever it was, 2.6% or something like that. Maybe it might have been 3%. And look at that, the fourth quarter is better than expected. Well, right now, as you and I speak here in mid-March, which with only 2.5 weeks left to go in the first quarter, that Atlanta Fed estimate of first quarter GDP is at 0.2%. Okay, so pretty clear the U.S. economy is slowing. In the individual metrics like retail sales or durable goods or inflation or even the most recent employment numbers, all of that is showing this slowdown. Again, the economy just can't handle these higher interest rates. We saw what it did to the stock market, okay, when the 10-year note got up over 3%. We've seen interest rates rise for credit cards and mortgages and everything else. And it all has this accumulating effect of slowing the economy.
Now, with respect to the, short term for precious metals, you recently commented on how the open interest is extremely high. How will that impact the price going for the short term going forward?
Yeah, people, again, need to understand, these prices are determined by the trading of these derivative contracts. And the banks, which own seats on the exchange and act as market makers, the banks are the ones that create the contracts, either by themselves taking the short side, or they have in some cases, a mining company comes to them and says, we want to sell forward, 100,000 shares of gold production, 100,000 shares. We want to sell forward 100,000 ounces of gold production. Well, 100,000 ounces is 1,000 gold contracts. So the bank then issues the 100,000 or the 1,000 contracts, and the speculators buy them, and that's how it works. But the banks can also take that risk upon themselves, which they often do, and say, look, we're just going to take the short side. And in creating these new contracts, you increase the size of the float, if you will, the amount of available contracts. Now, on any given day, let's say, Elijah, pick a stock. Well, what's the first company that comes to mind when I say pick a stock?
Let's see. I mean, I normally focus on the indexes, right?
But, you got an iPhone?
Sure, Apple. Let's say.
Okay. All right. So on any given day, news comes out that says, Apple has opened up a brand new market in wherever with the iPhone 66, and their sales and revenue have taken off and all this kind of jazz. Well, now everybody wants, that's good news fundamentally. And everybody says, I want to buy me some Apple shares. Well, the supply of shares on that given day is static, right? I mean, Apple can always issue more shares, which increases the float, or all these companies buy back their shares, which decreases the float over time. But on any given day when a news hits, the float, the amount of available shares is constant, it's static. And so when you get more buyers interested in buying Apple, the price has to move up to a point where sellers emerge. They say, okay, I'm willing to part with the 1,000 shares of Apple here. And all of a sudden, that's the offer. All these buyers are on the bid, and this higher price emerges based off the supply and demand. That's not how it works, man, in the precious metals. So some days it's like that. Demand for the derivatives, the futures contracts, increases quickly on really good news, and you do get good price run-ups. But the banks have the ability to create more contracts. And so the float actually grows. And what we've seen the last week, the banks have created 60,000 new COMEX gold contracts. In just the last 6 days, they've increased the float by 14%. Can you imagine the outcry, Elijah, from Jim Cramer, or the people on Bloomberg, if all of a sudden Apple had fundamentally positive news, but the market-making firms, the broker-dealers, whomever, just had the ability to create new Apple shares from nothing. And all this good news hit, but price didn't move because all of a sudden all these new shares came to market to meet that good news and make an equilibrium for supply and demand. But that's exactly what happens in these futures contracts. And that's just is what passes for, hey, that's just the way it works. At the end of the day, the banks issue the contracts offering essentially to deliver metal in the future that they don't have. The speculators buy the contracts, offering to take delivery of metal in the future, essentially, but they have no intention of ever taking delivery. And in fact, to buy the contracts, they don't even have to put up, they only have to put up maybe 15% of the cash to do it. That's what margin's all about. And so you get this fake deal, The banks issue these contracts that have no relation to ever delivering metal. The speculators buy the contract with no intention of ever delivering metal. How is that in any way related to physical supply and demand? It's not. And so finally, as we speak, you and I have talked about palladium and the physical supply squeeze that's apparent in palladium. Even as we speak today, gold and silver, copper, platinum are all down more than 1%. But palladium is not. The palladium market's the same with these derivatives, but palladium is now being priced off of actual physical shortage. And you can see it now on days like today.
Yeah, and if we can get into what is happening in palladium, because it's very interesting. It has just been running up for a while now. It's above the gold price, which is extremely unusual. I don't even know if that's happened before. I'd have to look more into that. But
2001, I guess. But
okay. Yeah, I mean, it's very unusual, though.
Yeah.
So what is happening in palladium, and what are some of the bullish fundamentals that are causing it to rise so fast?
Well, depending on which source you cite, palladium has been an actual supply deficit now for as up to 10 years. Okay, so the amount of palladium mined versus the amount of palladium consumed has been more consumed than mined, right? So the above ground stocks are drawing down and all that kind of stuff. Now, the biggest producers of palladium are South Africa and Russia, all right? South Africa's got all kinds of mine, strike problems, and Russia has now been demonized, as this terrible place, and there's sanctions on Russia and all that kind of stuff for the last 4 or 5 years. So that's only exacerbated the problem. Palladium is used industrially, primarily in catalytic converters in cars. Okay, so this demand continues for palladium, but the physical supply is short. Now, there are two things that in these markets that indicate that that's in fact the case. One, what we call the lease rates in London. If you have to deliver 1,000 ounces of palladium as a bank, you've sold forward, for yourself or for, your customer or whatever, and you're on the hook to deliver 1,000 ounces, but you don't have 1,000 ounces. You've got to go borrow 1,000 ounces from somebody that does. And those lease rates to borrow are now over 10%. They've been as high as 30%. Okay. So that's one indication that, I'll give you my palladium, my 1,000 ounces, but I'm going to demand that you pay me back 1,100 ounces. Okay. That tells you right there that there's a short supply. Then you look at the futures board. Most folks know, from the spot price out on the futures board, prices should always go up. That's called contango. In palladium, the spot price is above all these futures prices. That's called backwardation. And backwardation is always recognized as an indication of supply squeeze. So you got all these things coming together. And that's what tells us that there's this supply squeeze. Now, I mentioned, you said, has this ever happened before? Yeah, back in 2001, the price of palladium shot up to $1,100 an ounce from $400 over the course of 9 months. And as legend has it, because I wasn't following palladium in 2001, as legend has it, Boris Yeltsin, as head of the Russian Federation at that point, was convinced to kind of ride to the rescue and alleviate almost an identical problem in London. And price crashed from 1,100 back down to 400 over the next 9 months. Now, maybe that'll happen again. I don't know if Yeltsin's actions will be duplicated by Putin, the way the world is these days. But if suddenly a whole bunch of physical palladium shows up, then the price is going to go down. But it's very important people understand this is not some big speculative bubble, where people are buying physical palladium, and ounces and bars and buying futures contracts. The total amount of futures contracts on COMEX is actually flat, stable over the last 6-8 months. Trading volume is flat to stable over the next 6-8 months. So this is driven, again, by physical shortage. And that's why, again, on days like today, when the paper prices of the precious metals are all getting smashed, palladium just actually ticking along higher because it's it's more like a normal, what you'd expect. Physical demand is driving price.
Now, do you see it could go much higher from here? I mean, would this be what is your perspective on investing in palladium right now?
Yeah, I've been telling people now since when we really started talking about this was in the fourth quarter last year when we were at first moving up toward 1,100, the old all-time highs, and then we blasted through there to 12. And on my side, in every interview I've done, I've said, no, I don't want people going out and buying themselves ounces of palladium because who's going to get blamed when it goes back down, right? Oh, that guy, he said that everybody had to buy palladium. Look, my only hope in palladium is that it exposes the game in the way these other metals are priced. That if all of a sudden the physical amount of palladium out there in the world completely dries up, and these banks are on the hook and they don't have any to deliver for all that has been promised and sold forward, and you get like a force majeure, not only in New York but in London, my hope is that people would, they'd get enough press and people would sit back and go, hey, wait a second. If palladium is structured as a fractional reserve thing with all these leases and promissory notes and futures contracts, maybe gold and silver are the same way, like that one goofy guy that his TFMetals report's been talking about for the last 8 or 10 years. Maybe palladium will completely collapse, the market will collapse, and you'll have to find a new price at $5,000 an ounce or something, and nobody will care. I mean, that's a possibility too. The whole thing could blow up and whatever. So we'll see. Again, now that it's a physical supply-driven market, I have no idea what price it might go to. And if some way, somehow, a whole bunch of physical palladium shakes free, or if over the next 12 months, a manufacturer is able to shift to, rhodium or platinum or some other metal as substitute out of, palladium because it's gotten too expensive, then pressure will ease.
And can you specify a bit more about why the palladium market can't be, why it is different than the gold and silver markets? Like, why is it that the palladium market is more influenced by physical demand?
Well, I think because people recognize that it is a physical problem. Okay, so you don't have short sellers. In New York and in London, there's an active, not only banks, but also speculator, hedge fund, short sellers. The hedge funds will come in and short the futures contracts primarily on how they look technically. Like last year, back in the middle of June, the price of COMEX silver crashed down through its 50-day moving average and its 200-day moving average on the same day, June 15th. Price then went from 17 and change down to 14 and change in the next 60 days because all these speculators, hedge funds, saw how terribly it looked technically. The computers just act because they're programmed to sell when it's set up that way. And you get this cascade, just position after position added. Everybody was talking about, oh my gosh, the Commitment of Traders report has never seen, speculators net short and all that kind of stuff. Okay. So there's a willingness in these paper markets that aren't called to the carpet to ever deliver physical. There's a willingness to just play the game, and you get banks, commercials, speculators can short. And palladium, people have figured out. Wait a second. The last thing I want to do is get on the hook to have to deliver 500 ounces of palladium, 5,000 ounces of palladium. The position limit in a COMEX palladium contract is 50. Each contract is 100 ounces. So if you have, if you're short the position limit of 50 contracts because you think it's a bubble and you think palladium is going to go from 1,500 to 1,200, you're on the hook to deliver 5,000 ounces at some point. Well, if there's not 5,000 ounces to be found, okay, what are you going to do? You're eventually going to have to buy it back. That's a short squeeze. And so anyway, to answer your question, that's why. Because there is no physical metal, the willingness to short it has been removed. And now it just simply trades off the physical demand. And that's, again, entirely different from what you see in gold, silver, copper, platinum, and the rest.
Craig Hemke, thank you so much for joining us today. I guess before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Hey, Elijah, I'll just leave the message that I've been closing all my interviews with this for about the last 4 or 5 months. I may be dead wrong. Okay, I've been certainly wrong about stuff in the past, but experience, is the best thing you can possibly have when you're trying to predict where things are going in the future, because you recognize trends and patterns and you go, oh, wait a second, I remember this happening before. And that's what I see now. We've been here before. Again, the similarities to 2010, economically, politically, geopolitically, you name it. They're all there. And none of the problems that led us to 2010 from 2007, none of those have been fixed yet. They've mainly just been papered over with trillions and trillions and trillions of dollars of euro, yen, all that kind of stuff. And so now here we are in 19, and the world is beginning to figure this out. So anyway, the time is now to be preparing for that TFMetals report. We talk about that every day and try to, as a community, support each other to kind of keep our wits about us as we go along. So please, everybody check it out. And Elijah, thank you for having me on. It's always a pleasure.
Yes. Thank you so much, Craig.